Welcome to Impact Investing. I'm your host, Jeffrey JP Potvin. Today, we're honored to have Kamal Hassan, managing partner of Loyal VC, joining us from Toronto, Canada. Kamal is a seasoned entrepreneur, angel investor, and venture capitalist with an impressive background spanning multiple industries and continents. With over 20 years of entrepreneurial experience and an MBA from INSEAD and a degree in engineering physics, Kamal has traveled to over 100 countries, speaks 5 languages, and he's not just an investor, but he's also a passionate advocate for entrepreneurs who combine profit with social and environmental impact. Kamal, we're super excited to have you join us today.
Excited to be here.
Well, I think there's been a long time that I've been following you. I joined one of your venture days a few years back. I'm going to say it was pre-COVID or was just before COVID happened. You guys ran an event, and I got to sit in that. I think it was 2019, to be honest. So I've been pretty excited at the opportunity today to get to learn and chat with you more about not only the great things you've done in your career, but of course everything you've been doing inside of your fund, because you guys are doing some pretty cool things where I think you're tying your passion of global world travels and you're tying that into being able to invest in entrepreneurs globally at the same time, which is so exciting and a pretty cool structure. So the way we like to kind of kick off our show and start things off is we'd love for you to kind of share a bit of your background from your MBA days to the companies you started, and just kind of give us an overview. And from that, if you can also share one thing about you that nobody would know.
Sure. I'll start with one thing which nobody would know, which is I have taken the pilgrim's path up the Patala Palace in Lhasa in Tibet. And that's certainly before my MBA, I did a fair bit of traveling after as well. Um, the, uh, the journey which took me here, so I started as an engineer, but the journey which took me to what I do today is the engineering physics and working as an engineer really taught me about uh, wor- working in an environment where you experimented, where you learned what was true. You didn't, there weren't, the physical world can surprise you with not working the way you think it should. So, really taught me about the importance of thinking about things and discovering what is rather than feeling I already knew what is. Um, the After in Seattle, I worked at Bain and Company as a consultant. The last case I did in Bain and Company was a case on microfinance. And there are multiple aspects to thinking about this. This was a microfinance case, which was a great program the Canadian government ran where people who were unemployed continued to draw their unemployment insurance while being given support to launch a business. Now, that support was training and skills. It was not funding. And we were looking at how to fund these. And that is a whole aspect. I mean, you can definitely invest in impactful entrepreneurs. You can also make an impact by giving people the opportunity, giving people who can be amazing entrepreneurs access to entrepreneurship through giving them the capital they are missing. And that's really what that was about. And that's really stayed with me my whole life and is one of the underlying principles of Loyal. I then, as you said, was an entrepreneur for 20 years. Handful of different companies over that period. I started with travel publishing in Eastern Europe. I've done publishing, I've done hardware, I've done software. So I've done a few different things over that period. 15 years of that, angel investing. I first tried to launch a fund using the principles of micro equity investing probably 20 years ago or so now. The world wasn't ready, technology wasn't ready, and I reverted to this 8 years ago, launching Loyal, because the world of IT, the IT tools to manage information efficiently, to be able to to make small investments economic, started to all come together. Um, yeah, I'm sure we'll get into more things from there, but that was sort of there, and then launched Loyal 8 years ago. And we've now got investments, I think, in 64 countries around the world. As you said, I combine my passion with my work, and it's been a lot of fun doing that.
That's an incredible story, and I love the fact that you were able to find that way of tying the passion together with of course with investing and working alongside entrepreneurs, which is also passion because you've been an entrepreneur for a long time. So it kind of all packages nicely together. Now to kind of go back and look at it, well, I want to jump in, of course, with one thing about you that no one would know. I think that's pretty incredible that you were able to do that. And I had a side story where I was trying to get into Tibet, and it because you have to obviously apply for a Chinese visa, and it was during COVID. I was gridlocked, and I couldn't actually get in. So I ended up hanging out in Bangladesh instead because I was not able to make my way through. So, but it will happen one of these days. My plan is to go in and do the exact same trek. It's pretty amazing. I can't remember the distance that goes all the way around, but you have to hire an actual group to take you through. And I'm not used to that. I just travel by myself and just go. So now there's you have to have all of these other factors set up. I'm like, well, this is going to take some planning, and I'll have to re-engineer that. So it's pretty cool that you were able to do that, and that it was a big part of your life, which is awesome. So exciting.
Do you know, actually, there's a good parallel to my investing there, because I was just lucky. I was in the right place at the right time. Tibet was closed to tourists at the time when I was planning to travel to China. I was in Western China, and I was just sort of entering China, and Tibet opened up. And you could actually travel there as an individual a few weeks before I arrived in the country. And my trip, I adjusted my trip to make it work. But it ties back to investing, because I've made 10-ish or so angel investments. And one of the things I learned there very quickly, well, I learned there 14 years later, as you learn, is the best deal out of my portfolio, I got over 30 times my money back. So I'm very happy around that investment. It took 14 years, and we can talk about the length of time things can take to pay off. But it was not the deal I would have expected to 30 times my money. It was very much I think there's a lot of surprising in investing. And certainly the way we approach it is we think about uh, you have to be able to react to unexpected opportunities, rather than feeling that, oh, here's this plan of how things will go, and it just everything goes the way it does. I've been an entrepreneur for long enough to know that one thing is guaranteed: it will not go to plan. It'll be either worse or better than plan. It will not go to plan.
And that's a great point when you're talking about how you're planning things out. And an entrepreneur will start off with business plans and canvas and all of these things to kind of structure the initial part of where the business is going to start and where it's going to start to move its way from there. So I guess in a way you're at your hypothesis stage, and you're out selling that hypothesis stage. And in my mind, I started thinking about not just the experiences that you were going through, but when I was going through and learning more about how our conversation would go, I started to kind of see this kind of trajectory where and how the investments that you guys were making. And one of my questions was that, do you feel that because of the high fail rates that are structured around entrepreneurship, is there a possibility that when you start to get to this scaling stage, that instead of pushing them to scale and to put all of this money in, you choose to say move the operator out, put somebody in place that might be more of I don't know if it's a business person, but someone that knows how to run a business, and you decide this business isn't scalable. We've now determined through our hypothesis, through all the work that we've done with you, financially, governance, etc., all of the measures that would make this a business. And we decided that you should actually just steadily grow at 10% a year. And we're going to turn this into an asset instead of treating this as a company where we're going to dump a lot of money into. So we're going to hold this off. We'll pay all the investors out over the next 5 years, and you'll take the company back. But we're going to make sure this company survives, but we're going to do it in a different fashion. We're not going to treat this as a large scale up, or that it's going to go to a fail. Do you think that in all of this journey, do you think if we pivoted the way we start to operate and invest in companies and find a point where we know this company isn't going to be a go to stock market $100 million 5 year revenue company, that there's a possibility of changing the narrative with some of these companies and help them survive and actually grow and become part of the economy?
So I absolutely think narratives can change. I think actually the first part of the narrative which can change is um, A lot of venture investing comes from the private equity world. That was what came first. Private equity is still the big brother to venture capital. And a lot of how venture capitalists invest has come from that world. And just the whole language around deciding what the future of the company should be, and as an investor, driving the future of the company is very much the way private equity works. They take an existing business, they take it over, and they plot its path forward. Private equity is about optimization of an existing model. Venture capital are backing businesses which really do not have a clear path forward, and they require innovation more than management. And when you start thinking about innovation and you're being managed, in many ways it's the difference between being a business manager and managing artistic talent. And artistic talent needs to be managed very differently and allowed much more free reign to go out and create the things they want to create. So I think the first thing is there's just this mindset of what should we do as investors. As a private equity investor, control, swap management, do all the things you need to do. As a venture investor, it's very much about supporting talent who are creating and doing things that a business manager cannot do on their own. And so, who should chart the path of the company forward? In our view, it's the entrepreneur. Now, that's sort of that's also our approach to investing. We have investments in over 300 companies right now. We cannot possibly run over 300 companies, but that's fine. We're not looking to run the companies. We're looking to invest in entrepreneurs who will run their own company. And fundamentally, the person who spends every day, the person who knows the business the best is the one who spends all their time thinking about it. So there's a lot of, if an entrepreneur, we have conversations with our entrepreneurs all the time about what is your vision for the company? How can we support you in the vision? And we can see entrepreneurs change. There's one of the things you see, and you hear it in pitches. I remember judging a pitch. So what you hear and you see is that women will often present a much more realistic, short-term, modest pitch, and a man will present this great big pitch. And I was judging a pitch competition in Switzerland, and a man stood on stage and said, "This is going to be $1 billion business." And then a woman stood on stage and say, "I've got a detailed plan for how this is going to 100 employees." Now, you're not going to be $1 billion business without crossing the 100 employees first. So you can argue about, but the whole point is that's completely immaterial there. And then what you'll find is say, a woman who may start off sounding like her vision for the business is a very modest vision, and then she starts developing the business, and all of a sudden the opportunities change, things change, and you just react to it. It's like, oh, wow, I didn't think of this as $1 billion business, or I did think of this as $1 billion business. I've hit a plateauing point. Let me figure out how to regroup. Maybe it's going to stay. We have a business which is, we invested in Brazil, which is a tutoring business. And basically, it's in-person tutoring university students to help support K-12 students when they're doing their homework. He talks to a school, signs up a school, and then provides on-demand tutoring for all the students in the school for the school year for a sort of fixed fee per student. And he was running that business, and there was sort of a natural plateauing to how big this business could get. So it's a very normal looking business. Well, along comes these large language models, AI, and all of a sudden he started to adopt that because he found that he could use AI to answer questions for students. And in fact, there were a number of students who preferred to have the AI answer the question because they didn't want to look stupid in front of a human tutor. They'd rather have the AI explain things to them. And then he used the tutors to review the AI to ensure the answers the AI was giving were accurate. But all of a sudden, here's a business with a natural plateau point. You would have thought, oh, it's a slow growth business. And all of a sudden it's taking off because he's cut his costs in a quarter of what they were. And now he's talking about visions like, how can I get every student in Brazil to have access to this as part of the education system? It's not plateaued out at who can afford it. It's something which can be given to every student. So I think there's a lot of that. You may think you know where it's going, but you don't pick where it's going as the investor. The entrepreneur does, and the entrepreneur doesn't really pick where it's going anyway, because the entrepreneur will react to whatever they think opportunities may change.
Do you think is there a percentage number of when you look at a business to make an investment early on and continue to follow on with that investment, is there an early percentage when you look at it and say, this is 80/20, 90/10, that this is going to be successful in your mind when you start? And does your hypothesis change because of the metrics that you're provided year over year? Or does it change on the acumen of the entrepreneur? Or does it change on the market variables that you start to shift your 90/10? Like, this is a 90% success rate at the beginning when you first invested. 3 years later, you're now at a reverse, 10% success rate. What are the variables that change in your mind? And what do you find typically is the variables that change the most for you?
Yeah. Um, we spend, and I personally spend a lot of time trying not to prejudge how things will go. And the best thing I would suggest any investor is who's looking at being a venture investor is take a look at the Bessemer Ventures anti-portfolio. So this is a selection of companies they said no to and why. And that includes Google, Facebook, Apple, PayPal, Tesla, Coinbase. I mean, Airbnb, you name it. There are companies that they had the chance to invest in. They had the chance to invest in Google and said no. They had the chance to invest in Facebook. And for instance, Facebook, their answer for why they didn't invest is they said, "Hey, kid, have you never heard of Friendster? It's over. Give up." And for me, the lesson I take away from this is it doesn't matter how brilliant you are, the future is not written. You can sit here and say the future is predestined, and I'm smart enough to know what the predestiny is every company given what I have today. Or you can say the future is not predestined. Look, one of the businesses I ran is a business that does technology which enables car tolling technology, car tolling technology. It did more than that, but I'll call it car tolling technology. And we were looking at selling this to the government of New York, the New York Transit Authority, to be used for tolling in the city of New York. And those conversations we were having with them were happening back in 2010. And they really wanted to do it. And here we are, 2025, and New York has just rolled out their congestion pricing. And you can say it was predestined, it was always going to take them 13 years, or you could say it could have happened in 2 years. And if it had happened in those 2 years, so for me, replaying that, it was not guaranteed that New York would have taken 13 years. And by the way, that company failed as a result. If that had taken 2 years rather than 13 years, the business I was running would have been a household name today. And there's just a lot of these things are things I don't believe there's this predestined. I think things are unpredictable. So I'm not going to walk in and judge an entrepreneur today. Um, look, I used to run an accelerator program. And there was one of the companies in that accelerator program where the woman was pitching to us, and she said, "Here I am," and she's a 24-year-old immigrant woman in Toronto who's been working for a phone company, helping them manage their sort of some back-end administration for a whole bunch of little shops. And she says, "I'm going to build software which will allow businesses to manage all of their different facilities around a country, like these little shops for the phone company. And there's this need here, and I'm going to build the software to do it." And when she was presenting this idea, oh, by the way, it isn't just the phone companies, this is multi-location businesses. Nobody does multi-location business software well. I'm going to build it. And it just sounds outrageous. And when she was pitching the idea, it was like, oh, come on, there's got to be a solution. Have you ever heard of SAP? Come on, this is just, forget it. But the way that accelerator program, Founder Institute, worked is we didn't say, no, this business isn't going to succeed. We said, well, we don't think it's going to succeed. Why do we think it's not going to succeed? We think it's not going to succeed because no business will ever sign up for this. There's already solutions out there. So then you set her a task, which is, okay, well, if you can go out and find in the next week, if you can find 3 businesses who will sign a piece of paper saying that, yeah, they'd like software like this if you built it, then sure, you can stay in the program. Thinking to ourselves, oh, she's never going to get them. Well, she went out and got those businesses, and fast forward to today, and she went through multiple iterations. I mean, she went through 5 CTOs building the software. Everyone always advises you've got to get this one feature, build around the one killer feature first and expand from there. And she was like, no, 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 we have to start with 10 different pieces of software all integrated together. You have to manage marketing, you have to manage store security, you have to manage all these hiring, you need all these operational things in one mega piece of software. A disastrous investment, breaks all the rules. And here she is today, and the software is out and working, and she's got a bunch of high profile clients around the US and Canada and the UK. And it's just like, she made it work. So I really don't like prejudging, because you will be wrong. Sometimes the companies you are sure are going to succeed are the ones that fail, and the ones you're sure are going to fail are the ones that succeed. So I really like to approach it with an open mind. Um, and that's really, by the way, when we pick companies, the way we invest is we do very small first investments. So we're picking companies not because we think they're going to succeed. We pick companies because we can't see a really, really obvious reason we're sure they're going to fail. And then when we do that, we start off with companies, we put a $10,000 first investment into them. The failure rate for businesses normally is 65%. Our failure rate to date on those $10,000 companies we put $10,000 in is 40%, and it's tracking towards 65%. Give it time, and it'll be around there. Then what we do is we do due diligence on companies every month. We have monthly phone calls with companies. And that was the second part of your question, is how do you, in terms of how quickly do you react? How quickly do you change your mind? We have to be ready. We have monthly calls with companies because we know things can turn on a dime. We have a company in Southeast Asia, which was a small regional producer of Thai sauces. And they were talking to us for probably over a year saying, oh, we're going to sell this to Whole Foods in the US. And we would laugh in our sleeves. And it was like, yeah, I gotta keep going, talk to them. Oh, fine, whatever. Boom, she comes back, and she actually signed a contract to be on 85% of the Whole Foods stores on shelf across the US. She needed to double her production. She needed instant funding for that. And we heard about that, I think 4 days after she signed the contract. And 4 days after that, she had an offer letter in her hand from us to fund the company. And by the way, she needed to double her production, was going to double her sales. We didn't double the valuation. We gave what we thought was a fair valuation. And she could probably have gotten more if she went out to the market. But that would have been a whole process to go through, rather than you've got a relationship with a good investor you like, they're giving you a fair price, just take the money and build your business. So that was so we believe that things can change extremely quickly. That was a business which overnight its prospects changed dramatically, and we reacted to that with funding. And that's a little bit about the way we think about investing. We don't think about investing that we think there's an element of right place, right time. And by having relationships with a number of plausible companies, we should be in the right place and the right time when they succeed. And by the way, our failure rate to date on our follow-on investments. So our first check is 10,000, our second check is 200,000, our third check is $1 million. And all sorts of people say, oh, can I get a $200,000 check without doing the 10,000 first? No, that's not the way we invest. We have to get to know you. We have to be able to evaluate the business. But our failure rate on the follow-on investments so far is 13%. So we have our follow-on investments are failing at a much lower rate, just because you're getting time to really deeply know and understand the businesses. And then we use that to inform our investing, which of course is pretty good for our returns.
I love that. And maybe to go back a bit to kind of unpack this, like, because a lot of the things that you're sharing about kind of your approach is that it's very open-ended, and that you can't be stuck with blinders on, and that you can't be following a process. Now, if I go back to your MBA days at INSEAD, is that that's really focused on structure. That this is how everything works, and this is the direction you take. Things aren't fluid. You put things in buckets. Finance works this way, operations works this way. And now you're looking at this business and you're saying, look, we're going to make bets. We're going to make a lot of these bets. So $10,000 bets everywhere. And then what we're going to do is we're going to stay in touch. So this gives us the ear of the founder. And then when things start to shift, we'll be the first ones there to say, hey, we're in, let's do this, which I love, by the way, because it allows for them to know that if I hit the right metric, these guys are going to back me 95% of the time. And that's huge for an entrepreneur. So you kind of shifted from being structured to saying we've got to be super fluid. We've got to have our hand in a lot of pots, which means there's a lot of moving parts. And we have to be able to stay on top of the game so that when an action occurs, that we can react and be ready to react. How do you shift your mindset from all that learning of, again, this is the process, this is how you follow things, to becoming more fluid with these founders and allowing the founder to stay fluid too and not be structured?
That's It's a really good question, because when you describe what an MBA is and how it teaches you to think, that isn't ringing true for me fully with my INSEAD experience. And it's really interesting. One of the stats about INSEAD is that 40% within 10 years of graduation, 40% of the graduating class are running their own business slash CEO level people in different businesses. And that's what INSEAD has always tried to teach. Is they've always said, if you want to be a marketing expert, well, you're going to Kellogg. You're not coming to INSEAD. They called themselves originally the Harvard of Europe, with the joke being that, hey, Harvard is the CEO, CFO is Wharton, head of marketing is Kellogg, and we want to be the CEO place. But they have the vision to say, well, if you want to think overall about business, where you need to understand, to run a business, you need to understand all the aspects and see how they all fit together. I mean, one of the things which INSEAD does, which is they've got this great program where and it's now become, it used to be optional, it's now a capstone course in the program. They put the students into teams, a management team of 4 people who have different roles in the company, who are running an actual company. So they've got a case of a real business, what it went through in the acquisition. I think they used to call it the first 100 days, the first 100 days after this company was acquired. And they put you through real life surprising situations that you need to be able to react to. So this is not one of the situations, but you can imagine, for instance, one of the situations could be that all of a sudden your major supplier, their factory explodes and you no longer have any source. You've got customers waiting to buy your stuff and your supplier isn't shipping you what you need to do. How will you react? What will you do? What are the things? And then they bring in experienced business people to play the part of your customer, so you can negotiate, discuss with your customer why you can't supply them because your supplier's factory blew up. But you're really doing those. So it's funny. I think they're thinking about their education of how do you give people that flexibility of thought to react to unusual situations.
They're tying it together to help you look at things more fluidly. So I like that it's focused as a CEO and it's saying, hey, we're not the CMO, we're not the finance where everything is very programmatic and structured. Let's look at this as that you have to be fluid. You have to be dynamic in your environment. You're going to be throwing things that you're not going to imagine are possible. And I think this is what's interesting is that even in when you've invested in these 300 companies, if you went and wrote a book and said, here's all the things I've learned over the last 3 years of investing in all these companies, you could probably make it seem like it was anecdotal stuff. Well, this company did this and this happened here. But when you compound that all together, they're probably all super unique problems that have happened in every single company. And it was the ones that were able to move to the next direction were the ones that were able to be fluid, either see it coming beforehand or reacted fast enough during that occurrence.
One of the biggest challenges we have as human beings is we are pattern making machines. We see meaning everywhere. This is why uh, there are so many people out there who are racist, because you see people of a certain race, one person, one interaction, one thing, and your brain goes, oh, pattern. I'm going to apply this pattern to everyone else I meet who looks like that person who did that thing. Um, and it is one of the things we have to fight against. I believe we have to fight against as investors is to not be these meaning making machines, to not go, oh, here's this silly little startup by a couple of university students who is competing against this Silicon Valley giant called Friendster. And these are a couple little guys in some little town, not in Silicon Valley, Boston, doing this little thing called Facebook. And we really need, and by the way, most of the time that pattern is right. To say, of course, the Silicon Valley giant Friendster is going to crush this little tiny upstart Facebook. But most of the time that's right, and sometimes it's wrong. So I spend a lot of time trying explicitly reminding myself that whatever meaning I think I'm making, where is the data? And this goes back to the engineering physics days is, okay, you have a hypothesis about how the world works. You can look for data to support your hypothesis, but you also have to look really hard at how much does this rule apply, and where's the data that disproves your hypothesis? Where's the data which should make you question and re-examine what you're doing? So yeah, I'm sure I could come up with all sorts of rules and things of what and how we invest. But yeah, I prefer not to draw those inferences and to be open-minded with every situation.
I think that's great, it's needed. I think too many people, like you said, have a bias to so many things, and I've seen this before where someone would say, "Why is this investor making it so hard to invest in me? Like the numbers and everything prove that this is a great investment. Why are they being so difficult?" Well, they've created so much bias, and walls have been created because the other 1,000 people before you created those, and they had to in order to protect their wealth and protect their value. And then when they do make that investment, it's because it's gone through the ringer of the food chain all the way to get to them at their stage of investment. And they either are open-minded or they're closed-minded until you can prove that one last little thing that's going to shift the market to allow them to be open-minded to your opportunity, because they've been blocked down by so many other failed attempts or failed promises. So I guess in a way you kind of lose along the way. You're going to lose a lot of hope around 90% of the reasons why people are pitching you. And you kind of mentioned this before when you were talking about when women pitch, they're more direct. They've got, here's my numbers for the next quarter, versus perhaps the male side is, hey, we're $1 billion company, or we're going to be this massive thing. And people can envision massive because massive's easy to regulate in their brain. But when it comes to metrics and numbers, if 95% of people don't understand numbers and metrics, which in my brain, all I care about is the numbers, I have to take that back and say, wait, we need to put a bigger show to this. We need to put more value out there because a lot of people won't see that. And when it goes to this metric side, people won't understand the metrics. So if you just throw metrics on the page, you're like, man, this is the best presentation. Everybody's going to love this because the numbers prove why this is going to be successful. And it's deer in headlights. The whole room is like, what are you trying to sell me? Like, where's the vision? And vision is usually broad.
Do you know, it's funny you're talking about well, it's funny you're talking about the vision and the selling. There is an important element. We as human beings are really good when we're being sold to. We're really good at evaluating the clues in the other person of whether they really believe what they're saying. And the thing about why men will more successfully sell the vision thing, not because they're actually talking about vision, but because men uh, can deceive themselves so much. Men have this massive, and not all men, there's a subset of men who are the ones more likely to get funding, who have this massive ego, who say that this is going to be $1 billion company, But it's not the fact that you say it's going to be $1 billion company, that you actually believe your own BS, that you actually truly are certain it's going to be $1 billion company, which is a completely irrational statement with no basis in fact whatsoever. And as an investor, I can tell you is much more likely to be wrong than right. But if you give the advice to a woman to say, oh, just sell the big vision, talk about how it's going to be $1 billion company, that doesn't work, because if the woman doesn't actually believe in her soul it's going to be $1 billion company, then people who are hearing the pitch will go, oh, you're trying to sell me something, you're pulling my leg, you're deceptive. So it's because that is what we can see. I mean, this is why sociopaths do so well, is we're good on picking up these emotional clues, and sociopaths are just like, okay, I know how to make you believe something. I know how to control your reading of my emotional cues, because I'm not built with the sort of the standard emotions that we use, that we're able to read to see, oh, someone's saying something and she seems a little nervous about what she's saying. Oh, maybe so it's, I think it's more complex. I mean, one of the things we do, um, it's really interesting. So, industry average 3% of venture capital dollars go to a company with a woman CEO. In our case, we've got 31% of our portfolio companies have a woman CEO today, for instance. And we think this is a massive market opportunity, but we think it's a massive market opportunity because our whole industry evaluates based on pitches. And listening to someone pitch, there's lots of data out there. There was a Harvard study on this, for instance, which shows that an identical script voiced by a male or female actor with photos also of a good looking or bad looking male or female actor have a dramatic difference between men, and the good looking man scoring highest. I mean, just a good looking man versus a not so good looking man. When you hear the pitch, you're shown a photo of who you were told was speaking. It's the same person speaking, and you're shown a photo of a good looking person versus a not so good looking man, not so good looking man. And boom, just that looks difference means a difference in whether you think you should fund the business. I mean, our brains are these crazy, crazy things that we can, that a group of hundreds of human beings, when shown a good looking man versus a not so good looking man's photo for in something which is otherwise identical, think, oh, this person's good looking, therefore, and subconsciously we're thinking this person's good looking, therefore we're more likely to want to invest in their business. And then women scored much lower than men. So
Yeah,
yeah. By the way, I wanted to return for a second to we were talking briefly about because you're an impact investor and you were asking me about patterns. One pattern that I have seen, which I try very hard not to 100% fix on because I haven't seen enough data to know, the external data I haven't seen hasn't backed this up yet, but we believe that entrepreneurs who are motivated by making a difference in the world are more likely to succeed than those who are not. Because, and I have data points on this as one-off data points, entrepreneurship often gets difficult. And I've seen multiple entrepreneurs where when things got difficult, when they were motivated by money and the opportunity, when it got hard, they quit. And when they were motivated by making a difference in the world, even when it was hard and it was completely irrational for them to keep going, they did so. They kept pushing ahead rather than stopping. So I actually believe it can be more profitable to invest in impact entrepreneurs. And we also have seen examples. I mean, we all know stories of you are more willing to fund someone who makes a difference in the world than someone who's just out there making money. You are more willing to work for a company where you really believe in their mission. So I actually believe that it can be more profitable to invest in impact entrepreneurs. But like I said, the data out there is mixed. Some studies say it is better. Some studies say it isn't better. And I have my own personal experience of where I've seen people quit who I thought shouldn't have quit because what they were doing didn't make a big enough difference in the world for them to keep going with it.
Now that's a very valid point, and my brain is running 100 miles an hour on a million questions I want to ask. And because we're going to shift segment, I am going to ask one question just because before we shift. And this was from this was a long time ago, and I'll just his name is Chris Carter, and he shared to me this. This was probably 20 years ago. We worked. He was an entrepreneur, and I worked for big business, and he works at Schulich. He runs the MBA program, and we've worked together for many years. And he had said to me originally when we first met, he said, if I gave you the opportunity to put $1 million in your pocket, and I work with you to help you build your company, and the $1 million is there, but you can't have it right now, but you'll get it if you do these three things: build your company, have some success, grow X. And then, but every time you need money, you'll pull from that $1 million, but it won't be your $1 million anymore if you start doing that. Would you be more driven because you had the financial structure that would support you? Would you use that money less because that was going to be your money? Or would you use it more because you want to build the company? And it makes me think in my mind to what you were just sharing is that if I went to you as an entrepreneur and I said, look, I want you to build this company for the next 4 years, I'm going to make sure that you're paid $60,000 a year for the next 4 years. I'm covering that. That is covered. All you need to worry about is building the company now. So you won't pay yourself any other more. Your asset is the value. So the company, the value is that. So whatever you can build at $100 million, that's your value, 40% of the company, whatever the number is. But I'm going to guarantee you're paid starting today. So go to work and build me a successful company. Do you think that, and everybody else, you'll figure out who you pay, which all those things as a business would. Do you think that you would have an entrepreneur be an entrepreneur if you put some levers that would allow them to make more money when there is more money? Would you have a better structured company that they wouldn't give up, that they got to a point where they said, look, I've got an asset now that's worth 100 million. I don't care that I make 60,000. I got a $100 million asset, or I got a $1 billion asset. Would that shift the mind of the entrepreneur to be more focused on building that asset because they were taken care of financially? They didn't have to struggle. Because I know angels tend to be, you need to be all in. You can't be paid this much money. All of these things that just make it like you're living on the worst, poorest structure of life, trying to build this company. All stresses in life are happening, and you're trying to focus on getting paid and build a company. Do you think it would shift the mentality if we looked at investing a little bit differently and support the entrepreneur better? And do you think you'd have better success rates?
I think it would shift the number of people who had the opportunity. Because let's be blunt right now, uh, when you are being paid 25, when you are being paid minimum wage or zero to run a business, the people who do that are the ones who can afford to do it because they have the savings to live off of. To be able to say, I don't care if I don't get a salary, I've got savings. I'll live off my savings. The house is paid for, whatever it is. There would be a massive increase in the number of people who could do it because there's a number of amazing entrepreneurs who just don't get the chance to be entrepreneurs because of that money situation. It's interesting. One of the companies we've invested in, so that $10,000, when I say, and that $10,000 we give companies is actually $1,000 a month for the first 10 months on condition they report, have a call with us every month and send us a report every month. And as long as they share the data and have the call, they get paid their $1,000. And if they don't, then they'll get paid the next month when they do those things. One of our portfolio companies wrote to me sort of in the middle of COVID, and he said, look, Kamal, without that $1,000 a month, my company could have never survived in COVID. Now, this is a company out of Egypt where $1,000 a month goes a long way towards covering multiple people's salaries. But he said very explicitly, this company would not have survived. This company would not have survived without your money. Thank you, thank you, thank you. And by the way, this is an entrepreneur, which has now expanded from Egypt more broadly in the area. His revenue is doing amazingly well, and he's looking to start to pay out dividends because he's got so much cash lying around it. He can't grow fast enough to use up the cash he's generating. And that all happened. This was someone who couldn't have kept their business going. I have conversations frequently with founders where I say, how much are you paying yourself? That's not enough. Let's increase your salary. Because for I know entrepreneurship is going to take a long time. It often takes longer than you expect. And if it's going to take a long time, I don't want you, the founder, to burn out. If you are not being paid enough and you burn out and the business fails, well, that's a business risk. And it's my job as an investor to ensure that you are looked after. Because if you quit, if you quit, a business is probably going to fail. So let's make sure you're paid enough that you're not going to quit. So yeah, I mean, I agree completely, both with the it's better for business to look after the entrepreneur, and also the just the opportunity set of there are so many great businesses which could be built if we structured ways. And by the way, it's I don't know if you've been following the discussion on guaranteed monthly income or similar experiments around. This was exactly what this program that I was the program that I originally back as a Bain and Company consultant was doing the microfinance program for. It was a guaranteed monthly income, launch a business with 12 months of guaranteed monthly unemployment insurance benefits. And that program had something like, it was like 95% of all the people who went through this program never claimed unemployment insurance ever again. And it's just like, so there's this, if you can give people the financial security to launch a business, there will be many more great businesses out there than there are today.
I love that, and there'll be a huge reduction of fraud that would occur because people would probably be going into it less into entrepreneurship to pay back their old debts and fix other things with other people's money to walk away from it. So you probably see a lot of change as well when you start to structure things that will benefit the entrepreneur, that will allow them some structure. There's still a balance of like everything's going to have risk everywhere, but I think it's a to your point, you have someone that made it through COVID because they were getting the dollars that you provided them to support that business, and today they're flourishing. So I think if you kind of help remove some of that early structure of negativity, which is I'm building this company and I have no money and I can't do this forever, so I don't go back and take a job that I don't want. I think it does structure some opportunities or creates a better balance in opportunities. And maybe this is a government intervention that helps, since 97% of countries are entrepreneurs. And maybe that is a way of structuring it. And to your point, not everybody's going to fit in the bucket, but the ones that do create more prosperity for the rest of the country because they're hiring more people, and you create more value and stability in an environment. So, well, in saying that, we're going to shift because I think you and I could just keep going on this. I love it, but we're going to shift into our next segment, and this is the 60-second rant. So the way this works is you have 60 seconds, and I will put the caveat in: no one's ever hit 60 seconds. You can rant. It's about anything that you're passionate about, and then I will do a quick rebuttal, and then you'll close it off, and then we'll move into our rapid fire questions. So I'm excited. We'll turn it over to you. I'm going to set the timer, and just give me 2 seconds here, and we will be ready to roll in 2 seconds. You're on.
I'm going to take off of what you said about government. The government in the world, which I think has done the most to build entrepreneurship, and the most, by the way, to do Sharia compliant financing, for those who have heard of that, is the government of the UK. And they came out with a policy which said you can get a tax break for investing in entrepreneurs, but you only receive that tax break if you invest in common shares. And that leads into the big picture, which is our industry seems to think that you as an investor should get a preference over the entrepreneur. You should have preferred shares, you should have debt, you should have safe notes which pay you out when the company fails. And what happens is when a company does okay, it gets acquired. It gets acquired for the price. I mean, corporate acquirers know this, enough money to pay back all the investors. The entrepreneur has nothing to show for 5 years of working below salary, etc. And what this does is it misaligns incentives. It makes companies more likely to fail. We have a company in our portfolio in Africa who failed because it was a good company making sort of $1 million a month or more in revenue, but it failed because their financing had been at a very high valuation, let's call it 20 million, and it had to drop now to 5 million. People were willing to put money into 5 million because all the investors had these preferences, these terms. It diluted everyone, it misaligned incentives. The company failed. And in my view is we as investors should be taking common shares, not preferred shares, not preferences. We will make more money. The company's more likely to succeed, and we make our money from the big winners, not the failures anyway. Clawing back money on failures is just hurting the entrepreneur, and it does nothing. So it's bad for society. It's bad for the entrepreneur. I think it's bad for the investor as well.
I love it. Well, maybe we'll call it the 2 minute rant, but I love it. That's very well said. And I would love to kind of formulate a rebuttal against it, but because I'm also super supportive of, to your point, is that I think that when you start to look at the way the money further up chain, when they come in, they have their reasonings that their money is short-term money. It's scalable, and I want my money out in 3 years. So I need to make sure that I protect this money because I'm coming in at 1, 10, 20, 100 million, and I want to protect that as best as I can. And it seems to almost forget that this company started 5 years earlier and that these were the people that invested before that. So it's almost like there's a disregard for the process. And everybody along this food chain is trying to protect themselves. And I'm wondering if to your point is that, can you carry this all the way through? Can you make the $50 million check less relevant and more just about scaling the business, but for protecting the entrepreneur and protecting all the previous investors? Just like Y Combinator came out with a quick, easy, safe, is there a document that now comes out that says, look, if you sign up as a company and you start using this structure, it can never be modified. It's a blockchain structure. When you invest in this, this is how it works. And this way, at the end, when this company is sold, everything is documented. Nobody benefits anything extra other than the fact that your 50 million was worth this much shares and this is the value, and we're done.
So there's a line in finance which is last money in makes the rules, and whatever rules you set in place initially, when the company's desperate for money, there will be investors out there who will put pressure on you to tear up whatever immutable rules you had and do something new. I learned this in my very first angel investment, by the way. I wish that could be done. It really comes down to the entrepreneurs having the character, and Steve Blank calls this a test of character, to say, are you willing? In his case, he was talking about cram down rounds. Are you willing as an entrepreneur to say no to cram down rounds? So yeah, I think ultimately the entrepreneur is the only one who chooses what happens in their cap table, and whatever they feel at the start, they may feel forced to change later.
Well, it sounds great, and I think we're fighting the good battle, but again, we have lack of control, like you said. Last money in makes the choice and the direction. So, but I think that was still a great rant.
Well, the entrepreneur has the choice. Last money in makes the rules if the entrepreneur agrees. So the entrepreneur is always the one with the final word.
True, true. The problem with that, though, is that, as you mentioned, it could be a down round. They really need the money, and sometimes that influence affects the choices that they make, and that's the tough one. It doesn't matter how good of the investors are beside you telling you not to do it. If you don't have that money there and you don't have a way to float the business, then you fail. And I think the mindset of failing is what really bothers people the most, because it's their baby. They want to make sure it succeeds, and they're willing to take what it does. And then at the end, if they're left with nothing, then they can be upset about the whole choice. But really, at the end of the day, they said, well, we still built something great, but we didn't make out with it at the end. So it's a tough decision. And I think that we got to avoid getting stuck in those tough decisions, which means there's probably more planning that you need to be structured in this process of when and how you're raising money. And I think, when the stock is down, you buy. So I think in this instance, you have to be making sure that you're always getting money when you're in the right up spot, so that way it benefits the business and growth. Okay, we're going to get into rapid fire questions. We're almost there. So this is on the business side. So Please choose one or the other based off of how you invest as an investor. Founder or co-founder?
Founder, not because we've got anything against co-founders. It's just we think that you can be a single founder company is maybe slightly harder to succeed, but you can succeed both ways.
Okay. Unicorn or 4-year 10x exit?
I'm going to wimp out here because we are an evergreen fund. We have no end game. So therefore, we are completely agnostic. We'll do both. Really don't care.
Okay. AI or blockchain?
Again, you're talking to someone who hedges their bets. I think AI will have more impact in the world than blockchain. And we have investments in both. We're not going to pick either, and you'll see a lot of money created with both. But I think AI will have more impact.
Okay. First money in or Series A?
First money in, because in our view, it's building a multi-year relationship with the entrepreneur. And of course, when you build a relationship earlier, you have a deeper relationship than when you come along later.
Okay. Board seat or observer?
I'm going to say neither, but if you're going to force me, I'm going to say observer. And the reason why, when you're talking about the relationship you have with an entrepreneur, you can be simplistically their friend or their boss. If you have a board seat, you are their boss. You are no longer your friend. You hear things as a friend that you would never be told as a boss. And we want information because that's what drives our investing decisions. I'll be an observer if I have to be, but I don't want to waste my time as an observer either, because even though I have no power, I'm still perceived as part of the boss network rather than part of the friend network. But I don't want that seat. We'll find good people to do the governance. That shouldn't be us. It should be other people.
Love it. Safe or convertible note?
Safe all the way. I had a company fail because we had a convertible note, and the convertible note holder chose to force the company into bankruptcy. And in fact, it was that company mentioned earlier, which was doing tolling technology. And we had customers ready to go, and a new CEO thought he could make more money by forcing the company through bankruptcy first. If you have a safe, you can't be forced to go bankrupt, and note holder can force that.
Fair. Lead or follow?
Lead only because it's more useful to the entrepreneur that way, but we are completely agnostic. We'll lead, we'll follow. We want to think about what's best for the business, and what's best for the business is getting money on good terms. And it doesn't really matter if the and remember, we have small pieces, so we're part of a whole bunch of businesses. And once we're in that business, we don't care if we lead or follow. We just want the company to succeed. Leading, though, is often more useful to the entrepreneurs, but there's been times when we've been a lead, the entrepreneurs come back and say, here's somebody else who wants to invest along with you. They're putting in more money. They'd rather be the lead. Do you mind following? And we said, sure.
Two qualities for a startup to stand out to you.
We do reference checks on entrepreneurs. One of the things I'm looking to hear is about direct, open communication of everything that's going on, whether it's good or bad. Because if they tell us what's going on, we can help. If they don't tell us what's going on, we can't. Beyond that, I'm really struggling to come up with a second one beyond honesty. I know it sounds silly, but I mean, sure. I mean, yes, a second quality would be someone who believes in what they're doing, because entrepreneurship is irrational, and believes in what they're doing because they feel they're making a difference for people in the world. So it is this passion, this belief in what they're doing, which will drive them to keep doing it even when it's irrational to do so.
Okay. Verticals of focus?
We don't have verticals of focus. We have networks of focus. Our goal is to be the funder of choice in 2 global networks. Those are alumni of INSEAD Business School and top graduates globally of the Founder Institute Accelerator. INSEAD, think of it like the global elite. Founder Institute, open to anybody.
Okay. Number of companies invested per year?
72. We do 72 a year. So we've done 418 investments so far in the past 6+ years.
Love it. Favorite part of investing?
Working with the entrepreneurs. It's so gratifying to. I have calls every month with entrepreneurs, and I just love it. I love supporting people, helping them. I mean, as you get older in life, it isn't just about your own success; it's about the success of people around you, and it's just so gratifying to have these calls with the entrepreneurs, help support them, and support them in their success and help them even when things aren't great. I mean, I don't have children. In many ways, this allows me to get that parental I get to get my parental stimulation from supporting entrepreneurs.
No, agreed. I love that. What is the piece of advice you give founders 9 out of 10 times?
So I'm just quiet right now because I'm thinking of advice. Um, sure. Uh, the generalized piece of advice is uh, find allies, get people to support you. If you're a solo entrepreneur, get a first employee who's working with you. If you're selling B2B, don't build a sales force yourself. Find out how you can leverage other people's sales forces. So it's how can you get others who support you in what you're doing, who can make your efforts so much bigger, and who, by having them support you, push you to be better yourself.
Great advice. Who is your mentor, hero, and why?
I've been asked this question a bunch, and I've learned a lot from individuals. I mean, the answer I've given in the past has been, and I can't even think of his name right now, which is why sorry, Reid Hoffman, founder of LinkedIn. Um, but I wouldn't necessarily I give that answer because I'm forced to give an answer. Not, I mean, it's amazing the things you can learn by just talking to different people, listening to how they do things, and I've got many sort of individual points of influence I can point to, but not one person from whom everything comes.
It's fluid. I love it. Is there, I guess, just super quickly, and it's just more high level insights. What is your favorite investment and what is your worst investment? And you don't have to say names, just maybe some circumstantial things that just enlighten people of things that can go right and can go wrong.
I am very disappointed in one of our So I have two stories to tell on biggest disappointment. One of them is a cram down round we've just been through with a founder of one of our companies where the founder felt forced into taking this cram down round, but the way the cram down round was executed resulted in um, more than doubling the number of shares given to the founder, and the founder had a choice. I get they felt forced into a cram down, but the cram down was much bigger than it needed to be because they felt forced into accepting these terms. And they said, oh, we need to hold X% of the shares. Um, so therefore, we're going to allow a more than doubling the number of our shares. In fact, it was much closer to, I think, to a tripling of their shares. And it's just like, you may feel forced into a cram down. You still have a choice for how much you can push back. And it's a character test. And I was really disappointed. Even though they said all the right things about we didn't want to do this, we felt forced into it. They could have taken more personal pain to look after their investors, which they didn't do. So I think that was a failure. Success. Do you know it's really hard to talk about successes in our business because successes are only successes when the company exits. Until the exit, it may look good, it may look like it's going the right way, but it's so, yeah. I mean, our biggest success, I mean, I guess financially so far, just because their biggest exit is a company called Keyless, which was an amazing story. Actually, I love this success story because Keyless was acquired by a Silicon Valley unicorn. They had cash now and cash later. We got the cash now. When came time to pay the cash later, this unicorn was in trouble. So they gave us the company back. So we now have this company back. We have shares in the company still, and we got paid cash. So sure, that's a great success, because I'd love to recycle that three more times. You sell your business, you get cash, and when the cash later, you get the business back again. I love that cycle.
That's awesome. It reminds me of some renters we had a long, long time ago, like 20 years ago. And uh, it was May 15. And he had told me he was from, I think it was Newfoundland. He sold his house and moved to Toronto and then was staying in property. And then I think 10 years later, he went back because of the downside and he bought his house back for a quarter of the cost that he sold it for. And then he bought it back his own home and he still lived here. And then he went and bought another home and he moved into that. And then he had now had his property back for a quarter of the price. And then the markets took off during COVID. So now he has a property that's worth 10 times the amount that he paid for. And it worked out quite well. So in the same instance, right, it's you got to buy when it's down and there'll be an upside later. So it's kind of cool that worked out that way.
That's actually maybe a good point to slip in for those who are thinking. If you look at the time we're having this call, now is a very, very good time to be buying in venture. All the data shows that venture is down right now, and nobody wants to invest. They think, oh, I want to be in public markets, which are at all-time highs. When actually, when something is high, you sell it. When something is low, you buy it. And now is a good time to be selling public markets and buying venture, whatever venture you invest in.
I love it. It's great insight. So we're going to move to the last segment, which is personal rapid fire questions. So we'll do this real quick, and then we'll wrap up. So, favorite book? I love it. Favorite sports team?
Toronto Raptors.
They need some work this year. Cake or fortune cookie?
Fortune cookie. It's less sweet, and you get the entertainment too.
Love it. Superman or Batman?
Superman. Batman's a little bit too much of a is a little bit too I don't know if edgy, but I don't like the dark side of him.
Fair. DC or Marvel?
I don't know the two universes well enough to comment. I hate to say it.
If you're going with Superman, you're going with DC, but that's all right. Yeah, it's good.
DC is good then.
Football or football?
European football for sure.
I love it. Elon Musk or Oprah Winfrey?
I know I shouldn't say this, but Oprah Winfrey.
All right. Big Mac or Chicken McNuggets?
Big Mac. Love beef.
Favorite movie and what character would you play?
So I'm showing my geekiness here, but Indiana Jones. I'm trying to remember the original, the Temple of Doom, I guess it is. And yeah, I want to be Indiana Jones.
Oh, that's awesome. That was childhood memories. Just, I think it's like Goonies. You're like, oh my God, this would be incredible. I love it. All right, we're almost there. Last question. What is your superpower?
I think it's that I am comfortable with uncertainty. It's what allows me to do what I do, that I'm many people need certainty to feel safe in the world. And I've just deeply in my bones understand statistics and probability, and I can work fluidly in a world of probability without having things be defined to a single answer. It's the good old physics, sort of electron probability cloud versus electrons in fixed orbits.
I love it, and I would say that just from getting to know you, the superpower too is that because you're fluid, you're not allowing any sort of paradigm to control or manage the way you look at things, and being objective is what enables you to invest in a lot of different verticals and have different theses that can change and moderate. So I think that's pretty cool. So it's very open-minded, and I think that means you get to take in a lot of information and learn a lot, and that would be a great value for entrepreneurs to be able to learn from. So I'd like to say that it's been incredible getting to know you and chat with you today, Kamal, and I'm sure we're going to get to do a second one. As I mentioned, I've got a lot more notes and questions we want to dive into, and look forward to hopefully putting that together. But in the meantime, you're a rock star. We appreciate everything you've done in this space, and we like to give you the last word. So anything you want to share to entrepreneurs, investors, or anyone in the markets, by all means, we turn it over to you to share. And please let people know how they can get a hold of you as well.
For entrepreneurs, come in through our website. We are very clear on our. Many people say have a website up and say apply through the website, but actually you need to come in through an introduction, not through the website. I can tell you that 95% of who we funded has come through the website, and the other 5% has come in only because one of our investors said, "Hey, here's a company for you." So that's for entrepreneurs. For investors, think really hard about the long term impacts of what you're doing, not just the short term. It's really easy in the short term to go in for preferences, think that'll help you. In the long term, it means the company will have preferences stacked on preferences, stacked on preferences. And whatever preferences you got today, you can be sure the next investor is going to have the same or more. So think really hard before you do preferences, because it will probably come back to bite you as an investor as well. Um, yeah, and do common shares.
I love it. Well, Kamal, thank you very much for all your time today. It was great chatting with you, and looking forward to continuing to follow your journey and learn more in the future. But thank you again for your time.
Pleasure. Thank you very much, JP.